Did you know that your credit history is like your financial calling card? A bad score can close doors for you. From applying for a mortgage to financing a car or even renting an apartment. The good news is that your score isn't fixed. You can improve it with concrete steps. Today I'm going to explain what it is, how it's calculated, why it's so important, and most importantly, how to raise it quickly without any weird tricks or magic. Current problem. In 2025, most banks, finance companies, and even landlords look at your credit score. If your score is low, they deny you loans. They offer you loans with very high interest rates. They even ask you for guarantors for rentals. Real-life examples: Spain and the United States. In Spain, appearing on a SNEF national taxpayer service for a debt of just €50 can prevent you from applying for a loan in the United States. A FICO score of 580 can mean 20% interest on a credit card, while someone with a score of 750 pays only 12%. A bad score not only limits you, it also costs you thousands in interest. How the score is calculated. This is where many people get lost. Your score is a number that reflects your risk level to banks. The most common factors. Payment history, 35%. Most importantly, every late payment is recorded. For example, an unpaid €30 bill can reduce your score by up to 100 points. Credit utilization, 30%. The ratio between what you owe and your credit limit. If your card has a limit of €1,000 and you use €900, your ratio is 90%, gives very negative. Ideally, less than 30%. Account age, 15%. The longer you have an account open, the better. Closing an old card, even if you don't use it, can lower your score. Credit diversity, 10%. Having just one card isn't the same as managing several types of credit. A card plus a personal loan plus a mortgage. Banks value your ability to manage different products. Recent applications, 10%. Every time you apply for a loan, a hard inquiry is generated. Several in a short period of time suggest you're desperate, gives your score drops. Examples and concrete solutions. Practical example of poor management. Person A has two cards. Card 1, limit €1,000, gives uses €900. Card 2, limit €500, gives uses €400. Total usage ratio, 86% result. Low score. Solution, pay off those cards until you drop below 30%. Using the same example, if you reduce your debt to €300 and €100, ratio equals 26%. In 2 months, you can improve your score from 580 to over 650 points. Key solutions: always pay on time, even if it's the minimum. Even better, set up automatic payments. A 30-day delay can affect your credit for up to 6 years in some countries. Reduce your balances. Target the highest interest cards first, the avalanche method. Even if you have money, never use more than 30% of your limit. Don't close old accounts. Keep old cards even if you don't use them. They add value. Diversify your credit. If you only have one card, consider taking out a small loan and paying it off to add variety. Avoid opening too many accounts at once. Don't apply for 4 cards in 1 week. This automatically lowers your score. Common mistakes to avoid. Paying late thinking it's okay. Even 1 day late can accrue interest and affect your credit. Using your card's full limit because I have it. The bank doesn't see it as capacity, it sees it as risk. Applying for quick loans, not only do they have extremely high interest rates, they can also damage your credit score. Closing old cards. This reduces your credit history and total limit, gives your utilization ratio worsens. Your credit score isn't an eternal punishment, it's like your weight. With healthy habits it improves. Paying on time, keeping debt under control, and avoiding common mistakes can change your financial life in just a few months. Imagine being able to apply for a low-interest mortgage or finance your car without paying double the interest. That's up to you. Start a plan today and you'll see results in less than a year. Like and subscribe if you want more strategies to maintain a clean credit history and leverage your credit to your advantage.